Thank you for making the time to be here to speak with me this afternoon. Okay, I'm going to go ahead and get started and share my screen. As Winnie rightly mentioned, right, one of the things we would be primarily what we'd be looking at covering for the duration of this hour that you're with me or that I have you here with me is understanding one, what are some of the myths and misconceptions that we have around the lending and the entire loan industry and the process of applying for loans, right? How do these things affect the way that we interact with the system by instilling a sense of fear or giving us a sense of hesitation when there doesn't necessarily need to be one? And finally, how does Oze come into, helping us navigate these intricacies by being that platform that we can leverage to borrow for growth and not necessarily for survival, right? So these are the three themes into which this workshop is broken down. And, it will feel very narrative. We would have the question sessions at the end of my little presentation, but if you feel so pressured that you can't wait, go ahead and ask me mid-presentation, I don't mind. Okay, so moving on. Just before we get started, I want to take us back to some of the basics of just understanding basic terminology that we would encounter just in the process of a loan application, right? Some of these things are very kind of borrower facing in the sense that you interact with these terms all the time, and some of them not so really, right? Unless you are a lender or you are a creditor or you're a source of credit, you might not necessarily have an idea as to what they are and how they play into the decision to either give you a loan or not give you into a loan, right? I mean, right off the bat, right, the very basic things, we all know what a loan is. It's borrowed money that must be repaid with interest. And that interest is basically the cost that I incur to give you a loan, right? So for example, if I decide to give Winnie a loan, and it's time for her to pay me back, not only is she going to pay me back the principal, which is the amount that I gave her, but she would pay me back interest, which is my opportunity to now make profits of giving her this money. Then there's something called accrued interest. And so what happens with accrued interest is, when you have a very fixed amount of time as to when you're supposed to pay money, how frequently, let's say it's every month, and you are supposed to pay a specific amount of the principal back plus the interest every month, and you miss a payment or you skip a payment, right? That cost or that bill just doesn't disappear, right? The next month you still have to pay a principal, but then now you have accrued interest, right? So you have the interest of the previous month that you skipped and the new month that you have to pay. And so what happens then is it actually works against you to skip because it's becoming more and more expensive for you. Your repayment schedule, like I just explained, is a process, through which you break down how you're going to pay back. And that's usually defined in the agreement that you have, your dettee agreement, loan agreement that you sign. Minnie, do you mind keeping track of questions? If there are any questions that come into the chat, please.
Sure thing.
Thank you. Finally, we have assets. Everybody knows what an asset is. It's something that is considered very valuable that you own or you have significant control over, right? For the context of this, going through these definitions, we would look at two types of assets, right? And you would later on in the conversation, you will understand why. We have assets that are liquid and assets that are illiquid. And these are just a function of how quickly can I turn something into money, right? So an asset that is liquid is something that I could very easily convert that into cash that I can use. So for example, if I'm a vendor and I have sold something to a customer in credit, and in 3 days, that customer is going to pay me back. That account receivable is, sorry, I'm trying to admit someone to the room, is a liquid asset, because in 3 days, I'm going to be able to turn that back into cash that I can spend, right? It becomes illiquid when it takes a little bit more longer and a lot more effort to start to convert that into usable like form, like usable cash. And so we think of things like property, like land, like gold. So some of the jewelry that you have that it actually is worth a lot of money, but in the form of gold, they aren't things that you can trade in until you figure out a way to next we have collateral. And collateral is just a guarantee that's placed on the loan that you're going to take, right? Not every loan requires you to place down the collateral asset. We have loans that are considered secured loans, which require you to 100% guarantee them with some form of collateral assets, meaning if I give you this loan, you're going to give me something of yours that I'm going to hold. And so until you pay me back all of what is owed, I will hold on to this thing. And if you don't, then I keep it, it becomes my own. But we have also non-collateral assets, unsecured loans, which are just loans that don't have any guarantee attached to them. And those are a little bit more risky, right? So the last three, maybe you might not see as frequently as some of these other ones that I mentioned, right? Your credit score is your numeric or even alphabetic representation that a lender uses to decide whether they're going to give you a loan or not. And it's just a score, right? It could be 90% out of 100. It could be an A+, it could be an F, right? If you get an A+, it means you're credit worthy and we want to give you money. If you get an F, it means you're not credit worthy and we don't want to give you money. NPL stands for non-performing loan. And so typically when a bank or any financial institution or any lender in an institutional form is giving out money, they do it by portfolios, right? So in each portfolio, there's always going to be some of those loans where we have people who are high defaulters. And so these high default, these borrowers who are really bad with paying back and default frequently are the loans that we would consider non-performing. And finally, there is something called RAC, which just stands for Risk Acceptance Criteria. And the way it works with different institutions is different. What RAC is basically is a predetermined standard or a predetermined process of defining how do we give you a score or not. So think of it like an exam, right? You take this exam that maybe has 10 questions, maybe has 100 questions, or maybe it is completely automatic, depending on who sets it. And the information that you put into this exam gives you a score, right? This exam is considered what that risk acceptance criteria is. And that score that you get is considered your credit score. And each institution has a different way of defining what their criteria for risk is. So now that we've gotten, and I really want you guys to try and remember some of these things because these are terms that will come up again later on in the presentation. And so I wanted to give a little bit of context here at the beginning. So let's get right into some of our myths and misconceptions, right? The biggest and most frequently used misconception is that only struggling businesses need loans, right? That if you're looking for a loan, it is a sign of a business that is failing and you probably don't have any money and you're probably poor and you should be out of business soon. And that borrowing from that point of desperate need is actually the very worst time to borrow. One. Two, it's not only struggling businesses that need loans. We have, as a matter of fact, a lot more stable businesses take advantage of loans because it allows them to free up some of their own personal cash and not have it tied up in operational things and have enough of a, like, I guess, enough of a financial history to be considered credit worthy, right? So it's actually better for business for you to apply for a loan before you get to that point of struggling, before you get to that point of, I'm desperate, I'm strapped for cash, I need a quick short-term loan, because those create very different problems that are, once you get into the cycle of those problems from, short-term cash-strapped loans, it's difficult to come out of the cycles. The second misconception that people have, or the second myth that people have, that is that more financing is always better. And what this means is that people tend to assume you should just get a big loan. You should just apply for a loan of 1 million cedis if you can. And that is usually not the right thing to do, right? Because you should always size the amount of money that you're borrowing to your specific need. Like, what exactly do you want to use the loan for? And it's important to do this, and it's important also not to just seek more financing. One, because more money isn't always the solution to the problem. Two, more money just means more cost, right? The more financing you get, the more expensive it is to finance that loan. And debt is usually the most expensive form of financing. The third one, and I talked a little bit about it earlier, is that you must always provide collateral for a business loan. It's absolutely false, because you have loans that are considered unsecured loans, so require no collateral at all. Oze, for example, is the type of organization that offers those type of loans that don't require you to kind of give up any of your assets temporarily for this loan. The fourth one, and this is a really important one, is that the interest rates are the only costs that you have when you take a loan, right? Let's say, for example, that I gave Winnie a loan. And what happens when people make this assumption is, let's imagine I gave her a loan for 5,000 cedis, and that's her principal amount, right? And I deposit that money into Winnie's account. So I'm like, here, we've approved the loan, go forth and prosper and make some money with your business. But then what she's seeing in her account dropping is not 5,000 cedis, she's seeing 4,500, or she's seeing 4,300. What has happened here is there are times where you will have origination costs depending on the terms that are in your contract. And so it's always really, it's always really important to ask, right? When you're in those early conversations with your loan officer, what are the costs that are associated with this particular loan? For example, now you can have costs around address verification. As a form of KYC, if I'm giving Winnie a loan, I want to know that the place that she has said is where her shop is actually where her shop is, right? So I am going to send somebody to go to that shop to confirm. And there's a cost that I incur from sending somebody to go to that shop. And sometimes I don't want to incur that cost, so I pass that cost on to Winnie, which means that amount comes out of the principal. Sometimes you have organizations, you have banks especially, that do this thing where they have an origination fee. So every loan that is processed, there's a specific origination fee that comes with that. Other costs that people tend to forget, one I already mentioned, is the increase in accrued interest that comes from missed payments, right? So for every payment that you miss or you skip or you're late on, there is interest that accrues that becomes expensive that you have to pay. And sometimes you have, in addition to that accrued interest, you also have late fees. And so we have now just gone from the idea or the perception that there was one cost, which is the interest cost, to realizing that the reason why Winnie didn't get 5,000 cedis was because there were 4 other costs that were not disclosed to her, and she never thought to ask anyone about. The next one is that when you get rejected from one lender, it means that all lenders will reject you. So there are situations where this is true. And an example of a situation when this is true is when you are a notorious defaulter, right? At that point, it becomes public knowledge, right? So in Nigeria, for instance, we have something called your BVN, your business verification number. Every bank account, I could have 10 bank accounts in Nigeria, but then I only have one BVN. And so if I take a loan from Oze and I've defaulted for 3 years and I decide, okay, let me go to EcoBank and try and see if I can get a loan from them. If they run my name through the credit bureau check, they will see that I have defaulted in different loans, right? So that's an example of a situation where you'll be rejected. But there's other situations where this is absolutely not, this doesn't come to play. So you remember when we were going through the terminologies, I mentioned something about RAC, which is your risk acceptance criteria. And I have said that with each bank or with each organization, is the way that they process, the way that their level of risk is different, and it affects the way that they set up that exam for you, right? So some people who are trying to be very conservative and they don't want to risk losing any money at all would have very strict rules around who they decide to give loans to. And if you if you don't meet the criteria for a bank or an institution like this, that doesn't mean that if you go to another organization, another fintech, or another lender who has a different, even more robust system, that you fail, right? You could find that they are more risk-seeking and want to have a bigger portfolio. And maybe the type of business that you're in is even specifically the type of businesses that they're targeting to lend to. So there's very different nuances around that. And so that's why it's completely false that once you get rejected by one lender, you always get rejected by another. The next one here is that the application process is always long and complicated. There are situations in the past, I think it's always been true in the sense that people still think of this process in terms of, you go into a bank and they give you this big folder of paperwork that you have to manually start answering all of these questions. And it takes time. And then, they give it to one person who gives it to another person, and that entire process is completely manual. But that's not always the case now, right? And that's the great thing about technology, and that's the great thing about improving and leveraging technology to scale quicker. Many fintechs, Oze included, are doing a really good job of making this process so simple that you don't necessarily need to use pen and paper, right? You download the app on your phone, or you go on the website and you click apply for a loan here. And in whatever software you're using, whether that be an app or whether that be a website, you're very easily and very quickly able to go through that process and submit a loan without necessarily ever having to go into a bank. The next one that I always find this to be sort of a comical one is that debtors will always get into trouble with authority for not paying back the loans. This is not true. I think there's this misconception that once you take money from someone, there is some corporate or government authority that is breathing down your neck with reminders and threats as to what will happen to you if you don't pay back the money. That's not true, right? In situations where we see people go to jail or get into deep legal trouble for not paying back, it's not because they didn't pay back, it's because there was fraud involved. And those are two separate things. As a matter of fact, what tends to happen to you in situations like this when you don't pay back the loan is detrimental to yourself, in the sense that you are just digging yourself a deeper grave, right? If your debt keeps piling up, it becomes difficult for you to come out of a state of debt. And so you constantly find yourself in a state of just in this very recurring, very vicious cycle of dependency that you will struggle for a really long time to come out of, which, if you ask me, is really worse than having authority chase you. Because what essentially happens, right? And it depends on the type of loan you get. Like, let's say you've applied, you've leveraged so much of your assets, right? And now you're knee-deep in 4 different loans. You run the risk of, one, losing your business, completely losing access to all the assets that you put on the line for the sake of all these loans. And then you're still never able to pay back. So you lost everything from digging yourself into this grave, which I think is the bigger fear, or should be the biggest scare, than this perception, this comical perception that like the police is going to be chasing you. The last two, so we have lenders always penalize early repayments. What I'm really trying to get you guys to understand here is, your contracts, when you apply for a loan and you're granted a loan and you sign the contract, right? Sure, you have to sort of stick to the rules and regulations that have been stipulated there. But then there's also room for flexibility. But for that to happen, you just need to have very open conversations with your loan officers or with your creditors, right? This is your situation. You want to pay back early. You want to sort of refinance that, and you have to make sure that this is something that is even accounted for in your contracts. And these are easy conversations to have. It's not a very hard and fast, very strict, this is the way it is and nobody can ever change it. And finally, this is very similar to kind of the first one that we talked about. The loans are only for emergencies. This is absolutely not true. It is actually significantly harder to get a loan for an emergency than it is to get a loan for, let's say you want to purchase inventory or for equipment financing, or you have a specific way in which you want to expand your business, whether that be hiring new staff. Because it's easier to build a narrative with the data that you have here, and banks consider you less of a high risk than someone who they're basically saying is desperate for money. And if they're desperate for money, it means that they're likely going to take this money and okay. So in the previous slide, I briefly mentioned something called the vicious cycle of dependency when I was talking about how, it is actually the biggest scare for you in falling into deep debt is never being able to dig yourself out of that debt. Because what happens when you borrow money from a point of survival, which is when you're borrowing for emergencies, which is when you're only borrowing because you're strapped for cash, is that banks know, right? It's very clear. The desperation is very palpable. And what happens is because they consider you high risk, you get worse terms. Like they give you shorter periods because they don't want to bear the risk too. They give you higher interest rates. You basically get the worst possible loan deal you could get because they consider you to be technically high risk. And what this means is the cost of getting this loan now becomes expensive for you, more expensive than it should have been because you have been tagged high risk. This eventually now turns into the fact that, we already know that you don't have money, which is why you came for this loan. And because the banks were afraid that you were not going to pay back this loan, they gave you really, really bad terms with really high interest rates that are really expensive for you. It now puts you in a situation where you are struggling to pay back because this didn't help your situation. It actually just made it worse and puts you at risk of now being a high defaulter. And what tends to happen when people go through the cycle the first time is the thought process of, okay, let me try and get another loan so I can finance this loan and, rob Peter to pay Paul, which would just repeat the cycle again. So now instead of owing one institution or one lender, you owe two. And you find people who will continue to repeat the cycle. Okay, let me see if I can get a third one, and let me see if I can push for getting a bigger one, right? Each time they go through the cycle, the thought process is like, oh, let me see how much more money I can get. But the reality is that you're not going to get more because people can see that you're desperate. And at some point, you're going to actually start getting rejections because institutions, bankers, lenders, credit unions, no one wants to lend to somebody who is not going to use that money to scale up or do anything that will bring them profits, but is just going to use that money to primarily service their own debt. And so this cycle perpetuates a dependency on borrowing to maintain your day-to-day operations, where even the profits that you would have been making is completely removed, like lost, because you're using every money that you make, every money that you borrow is taking into servicing all of your existing loans. And breaking out of this cycle is a really difficult thing to accomplish. Why is this red? Okay. And so I just explained really clearly what some of the challenges or some of the things that come up, some of the risks that you can bear, some of the risks that you would incur from borrowing from a point of survival, right? It becomes risky and it actually does more damage to your business than you think it is. And these are specific examples in which, right, outside of borrowing for emergencies or borrowing, at the point of I have no money and I'm cash strapped, these are other situations that will lead you into probably that same cycle. One is, I've just explained borrowing too late, right? What happens here is there should be very, very deep intention and planning at the start of the year or at the start of whatever financial period around, what are some of the things for my business that I want to accomplish? The current profit margins that I have, or the current sale volume I'm making, is that enough to sustain me? Is that enough to kind of keep me at the place where I'm making a slight profit, or I'm maybe consistent, like consistent even, or is it enough for me to now actually grow? And if it isn't, right, at that early point of planning and thinking through this process, that's also a good point to think about, okay, what are the situations in which, if I borrowed money, I'm not doing really bad yet, but I'm not doing so great. But if I borrowed money now, what would be the most ideal amount of money for me to borrow to help me achieve a very specific goal that I want to achieve? The second way in which people can make lending choices that are damaging to their business is choosing the wrong type of loan, which is why it's always really important to be very transparent with your loan officer or with the organizations that you are speaking to when you're searching for loans, because they will give you good and honest advice, right? You can avoid situations where what you want is something that could be done through invoice factoring or even financing, or a very specific type of funding that is specific for purchasing equipment, which will have different terms than if you took a loan that is for servicing your sales turnover or for expanding your business. Let's say you define expanding your business as hiring more staff, right? These different specific reasons have different like real life scenarios and real life implications, and it affects the terms that they give you. And so you might find yourself in a situation where you're just applying for a very blanket loan, and your loan officer finds out, okay, that you actually want this money because you want to purchase inventory or you want to purchase new equipment, right? It might be better if you take a loan product that is specifically tailored to that need that you have. And when people don't have these conversations and don't do this research ahead of time and just choose a loan product just very blanketly or very blindly, it could lead you down the situation where, okay, now maybe I have taken more money than I needed. I have taken less money than I needed, and now I have to go and borrow again. Or if I've taken more money, now this is going to cost me so much more to service. And the last example, now last situation is where you find yourself accepting a loan without understanding the cost implications. And many people do not read their loan contract. Nobody likes reading legal, which is fine. But this is one of the situations where it does you a whole lot more good to actually take your time to read through the contract that you have beginning, to understand the terms, not just with regards to costs, right, but with regards to what happens if my economic situation changes and I can't afford to pay in the way that I used to pay before, right? There's a lot of these conversations that need to be had early on. And I think part of there's so much fear, and people sort of tend to tiptoe around the loan process and the agreements, and they just take it in good faith as it is. And once they find themselves in a situation where they're struggling, they would either just go quiet and you never hear from them, and you don't quite understand as a loan officer or as a lender what is happening to the borrower. And before we move on, right, at the heart of these four issues that I highlighted earlier is two things. And sure, yeah, these are two controversial things, but I think these are two things that every business ought to ask themselves. One, right? There is no scenario in which you are borrowing from a point of growth or from a position of strength that doesn't involve consistent tracking and recording of your financial progress, right? There are some people here who actively use the Oze app. There's some of us here who don't and just have it signed up. And maybe every now and then you receive a push notification and you close it, right? Or every now and then you put in one transaction or two transactions or three transactions. It is really inconsistent. And these inconsistencies, they seem now like not that big of a deal until you have to apply for a loan and your turnover or your volume of transactions is just not looking ideal or not looking great. And it's putting you in a position where One, you might miss out on a good loan opportunity. You might be giving a loan, you might be sized for a loan that is smaller than what you had originally would have wanted, or what would have been great for your business because you just under-recorded all of the things that were important for you to track. And so this lack of consistent documentation is not only like poor fiscal planning, but then it also tells your loan officer, it also just shows a lack of managerial acumen, right? Because a good business owner should be able to plan these things out properly, think through them very intentionally, have software or anywhere that you're writing these things and keeping track of them. So at the point of loan application, wherever that is, whether that be with Oze or any other organization, you have the proof of these things here in a way that is readable and concise and actually usable. The second, I guess the second misconception or the second really big mistake that people make when it comes to lending or access to credit or wanting to borrow is assuming that money is going to solve all your problems. Like you hit a roadblock in your business and your first instinct is, oh, I need to apply for a loan. I need more money. More money is going to solve this problem. That is not always the case, right? And you need to be able to stop to ask yourself, why exactly do I think at this roadblock that I've hit, why exactly do I think that money is the solution that I need right now, right? For example, if you're having a situation where maybe you're getting close to a cash crunch, right? As opposed to that being a problem of your not being able to meet demand or it's actually more of a problem of like a reduction in sales. This is a sales problem, not necessarily a money problem. And even if you get more money, even if you borrow more money, if you don't solve that sales problem that you have, money is not going to fix that, right? You just now you have more money, but you still have a sales problem because you aren't making as many sales as you need to make. And so the question you should be asking yourself is there something that I need to change in my sales team or in my sales approach to improve this before immediately jumping to the decision that I need to get a loan to solve this problem because somehow it is the only way to solve this problem. And the same thing happens with operations. But the point here is always to, at every point where you hit a roadblock and your instinct is telling you that money is what I need right now to solve this problem, ask yourself, is it really? And if you had more money in this instance, what exactly would it solve, right? Think of the scenario of this business owner who was in a cash crunch because his sales were bad. If he gets a loan now, right, and he gets more money and he doesn't solve the problem of his sales being bad, that money does nothing for him. Actually just creates a problem where like now my sales are dwindling. I have this loan that I took because I thought it would help me improve my sales, and it's not doing anything for my sales. I'm just going to spend this money servicing itself. I'm literally just going to pay back plus interest that I don't already have because my sales are still dwindling. And so these are really important questions to have with yourself as a business owner, have with your team, right? For those of us here that aren't sole proprietors or run their business on their own, to understand what would money necessarily change for me in the immediate of going to get of seeking this loan right now. And at this point, right, one of the things we should sort of be reflecting on is that the relationship we have with money and the relationship we have with lending should be one that is sort of poised towards a position of strength, right? Right? We look at money as a tool, as a means to an end, not necessarily as an end, not necessarily as the all be all of every problem that we have, right? And when we do that, we are able to actually spend more time pausing and stopping to think about debt and funding as a strategic tool to help us capitalize on market opportunities, to help you strengthen your competitive position without putting unnecessary strain on your financial health or risking your financial stability by taking a loan that you don't necessarily need by taking a loan that you didn't properly size, by taking a loan that you don't understand the loan terms of, by taking a loan that is costing you more to service than it is bringing any positive value to your business. And so we should be thinking about borrowing now from a position of strength. And in doing this, right, there's a lot of ways to think about this, but one of them is actually just a simple common sense check. And this is where I like to start from, right? Banks are in the business of giving loans, or financial institutions, any creditor is in the business of doing loans to make profits. They're not doing it out of the kindness of their hearts. They're not doing it because the pastor told them to, or they are God-fearing men and women. They're doing it because it is an opportunity for them to make money. And presenting yourself as a borrower who isn't an opportunity for them to make money on, they're not interested in giving you money. And when you're trying to put yourself in their position, which is what I was doing, right? The whole time I was thinking about how do I make this make sense to everybody, is just think of scenarios that maybe you've had or you haven't had, or you know somebody who has had, where somebody has asked you for money, or you can even imagine these scenarios because everybody has either witnessed it or lived through it. You have a friend that asks you for money, and you know that this person has asked a few other people for money before, and they never paid them back. And now this person is coming to ask you for money and telling you that they're going to pay you back. And you're like, I know that you're not. And so, I mean, you're not going to be inclined to say yes to giving your friend or whoever the person is money. And there's so many different scenarios that you can play this out with just in real life without even taking it to banks, right? You could have another person who comes to you, you don't know so much of their history. You know them through a friend, as a friend of friend, you know them in the community or in your church. And they tell you, look, I know that you have all this money. I need help with this very specific thing. This is exactly how I'm going to use it. This is how I intend to pay you back. And this is why I need it now, right? The narrative is very clear, is easy to follow. You understand that you understanding exactly what it is they want to use this money for, you understanding exactly why they need it and how this is going to bring value to them. And you're also seeing it as an opportunity for yourself. Okay, maybe I can make some money off of this, or even if you're just doing it not for the money of it, but for the ability to help, right? But when you're in a situation like that and the story makes sense, you're not hesitant to give it. Is when you find yourself in situations where this person has a really bad track history, or you're listening to the excuse that they're giving you, and you're like, how does this make sense as a reason why you need me to give you this money? Or someone is telling you, okay, that you should give me, and this specific example plays out to how short-term loans are bad, right? Someone's telling you, okay, you should give me 10,000 cedis now, and they will pay you back in 3 days. It's like, if you had it in 3 days, you wouldn't need it right now. So I'm not convinced that if I give it to you now, you're going to pay me back, right? And if we use this simple common sense checks and just putting yourself in that situation of, if I had money and somebody asked me for money, what would I feel comfortable hearing to be able to give them that money? It helps you put into perspective, right, sort of the way creditors think when they are reviewing applications, right, when they are asking for specific documents. Because at this point, what they're trying to understand is, what is the narrative? How does this make sense? How is the purpose of this clear, right? And how does this provide value, not just to you, but also to me? And so borrowing from a position of strength is putting yourself in a space where you are accessing finance when your business is in a robust or healthy financial position and has the capacity to manage that debt effectively, right? Borrowing from strength, the position of strength can also just look like you having consistency in your transaction history. And so what I mean by consistency here, right? Sometimes you look at statements, or you look at people's Oze transaction history, or any of their Momo accounts, and you're seeing very erratic patterns as to how money moves in and out. Even though the amount of money that might be moving could be really high, but the sporadicness of it is like, it's really high today, then there's nothing for the next 10 days, then it's really high again. would make you uncomfortable. Whereas if you saw somebody who you're looking at any of their statements, could be, from the Oze app, it could be their 90-day back statement, it could be their mobile money bank statement. And you're seeing, okay, the amounts aren't so high, but there's consistency, meaning this person is doing business every single day, right? That gives you a lot more stability. That gives you a lot more comfort. And just puts you in a place where you feel comfortable that this person you're giving money to is going to manage it properly, compared to the other person that has just really erratic, sporadic ways of moving money around, right? Sometimes borrowing from a position of strength can mean understanding the difference between borrowing to increase productive capacity and borrowing to increase consumption. And so if you think of it in terms of like, so for example, right now we are in, I think, what we could comfortably call an economic downturn, not just in Ghana or in Nigeria, but really across a lot of places, right? And so in as much as more people are needing money, banks and lenders are also becoming more careful about how they give money, because they too don't want to risk a loss that they cannot recover from. And so what that makes you think about as a business owner is, okay, if I have to convince these people now that I need this money and I will use this money for the specific purpose that I have set out to use it, right? You have to actually look into your business and understand what are the parts, like what are the things in my business that are driving revenue versus what are the things that are driving an increase in cost. Because in situations like this, what you want to focus on are doubling down on those activities that are helping you very directly drive your revenue. So these things are called revenue drivers, right? And those would be the areas to focus on in your business. And they're all different, right? Depending on the industry of the business you're operating, the type of business, what exactly you do, are you selling a product or a service? But understanding that in situations like this, borrowing from a position of strength means looking inwards and being able to highlight what those revenue drivers are in your business, and being intentional about, spotlighting those things and doubling down on those things by providing the resources and the funding to make those things scale up quicker versus something that is just going to increase your cost. So an example of something that would just increase your cost could be administrative expenses. So if in a situation like this, or in an economy such as the one we're in right now, and you're applying for a loan and the reason that you give is you want to expand your business, but then you actually want to use it to increase salary, then you're just increasing your administrative cost, and there isn't any guarantee that that's going to increase sales. And that puts you on the path back to kind of moving away from a position of strength back into a position of weakness, because you are now slowly starting to etch back into that cycle of, I'm going to be spending more money than I'm making, and I'm going to be spending all of this money servicing a debt. And if I don't start making money soon, I'm going to have to go and look for money somewhere else to continue to service this debt. And finally, borrowing from a position of strength can mean not being afraid to engage loan terms and loan officers when your cash flow situation changes. And this is something when there's always the reality, right, that your financial situation is not going to stay the same from the beginning of when you apply for a loan, or if it does, it means your business is actually not growing. Like you're just kind of staying flat. And so depending on the type of business, depending on the economy, depending on so many things, right, you find yourself in cycles where some months are better than others, like some quarters are better than others, significantly or even insignificantly. And in this situation, like borrowing from a position of strength means that you aren't shying away from your reality of, things are fluctuating right now, and you're able to engage your loan officer, and you're able to look into the contract and be transparent and be open and say, look, this is the situation that I have now. I know that it would be detrimental for me to fall into this cycle of just missing payments or completely going blank and nobody can find me and they're calling me and nobody knows where I am. Because it's not good for me in the long run and it's not good for you either. And so where can we meet ourselves in the middle for us to continue to finance this loan in a way that doesn't completely sink my business, but is meaningful enough for you, right? And so positioning yourself for strength allows you, gives you the courage and confidence to have these kind of conversations and not necessarily want to shy away from them. And so just as finally to wrap it up, right? This is how you would know, like these are the indicators of kind of being in that position of strength to be able to borrow for growth. One is that you have good financial records, right? There's no such thing as too much information when it comes to applying for a loan, because you need to be as detailed and as specific as possible. There's nothing that is considered irrelevant, because everything is feeding into a system that is going to tell you, okay, this person deserves this money, or this person should get this money for this length of time, or they should not. And so the more information you're able to provide, the better the chances actually are for you. And so again, I think I mentioned this earlier, right? Not just being consistent with, your financial statements or your bank statements, but even with your transaction volumes, right? If you're using Oze, how much of your real business sales and expenses are you actually capturing for that data to be useful? Because if you're not doing that many, you're missing out on some of the values that you could get from, fully adopting that product, right? Another indicator that you are in the position where you are borrowing from strength is kind of being able to restrict your cash flow to one account, because then it's easy to follow, it's easy to track. It tells a cleaner story around how you manage your cash, and it's more visible, and it's clear that it's more controlled because your cash flow is basically centralized, as opposed to situations where you have a business account, but nobody pays you money into your business account. They use a separate account, and maybe it's your personal account, and so you're essentially scattering your entire financial history across more than one account, and consolidating all of these things back together doesn't tell as crisp of a picture as when you have your information centralized. The next indicator, of kind of borrowing from a position of strength, and I talked about this earlier, is being transparent, right? You don't lie to your loan officers, because and let me give you a typical example why, right? If, let's say you were going to a fintech, let's say you're going to a company like Oze to apply for a loan. Sure, you might interact with a human being, right? You will click on the apply for a loan button. If there's any issues, you can raise a ticket, you have a phone call with customer success. At the end of the day, those decisions are made by technology, are made by machine learning. And the data does not tell lies. And so you actually are doing yourself a greater disservice by hiding things and just being intentionally vague, because all of these things that you're silently leaving out or hoping not to mention because you're afraid that this is something that could count against you, will actually count against you. Whereas if you're open and you're transparent and everything is accounted for the way that it is, without any funny, vague stories, it just tells a clean picture. Another thing that is a really good indicator of borrowing from a position of strength is having a good repayment track record, right? This is particularly great if you are a repeat borrower, right? So if you're a first-time borrower, this might be difficult for you to relate to. And this is where you have situations where people are tagged, blacklisted as just consistently high risk, because every loan that they've ever taken has not had good payment history. They have a history of late payments. They have a history of kind of just disappearing, right? Until they've accrued so much interest that they have to come back and start thinking around, okay, how do we refinance this? And then even with that, they still, aren't consistent in paying, right? Having the exact opposite of what I just described is so much more helpful for you as a repeat borrower. The worst thing you really want to do is put yourself in a situation where you are missing payments and then going just AWOL, because all it does is increase the cost of financing and make it even more difficult for you to pay off the money that you already have. You already have to pay. And finally here, before we move on, right, it's just having a very clear purpose for your loan. right? It's not enough to just say, okay, I want to expand my business. How do you want to expand your business? What exactly, in very clear, very detailed terms, what does that mean that you want to expand your business? What exactly, like, how would that now translate into an increase in sales? In whatever objective it is that you set for yourself. Because I keep using I'm sorry, I keep using the example of personnel, right? If you decide, okay, I'm getting something because I want to expand my business, and you're just thinking of it in terms of people, there's never a guarantee that that's going to increase your sales. It just means you're spending a lot more money on administrative costs, and you don't know what that might cost you so much more down the line than it's costing you now, because now you have a larger, inefficient staff that are making your sales and your profit margins go down. And as if that's not enough, you now have this loan that you took out to hire these people that you have to service, and you need to go look for where to get that money from. And so these things, when we talk about them like that, they seem exhausting and daunting and just, like a lot, but they aren't necessarily. And I say this because a lot of companies today, financial technology companies, do a really good job of being a support system for you through this process to help you go through the process and have the most efficient, useful experience and come out with an outcome that is best suited for you. And Oze is a company that does a lot of those things, right? I think a lot of you know already that Oze does offer loans. Another thing that Oze does is giving you the opportunity to build alternative types of financial data that is verifiable. And I think this is really important for like new businesses, right? New businesses would struggle the most with getting loans because you're new, you don't necessarily have the history to go off on. And so there's the larger need to rely on these alternative sources. And what are these sources that I talk about, right? I've mentioned them earlier. Right? You're recording your transactions, your sales and expenses, your payables and receivables. You're sending receipts, right? It means that if you're sending receipts, it means you're invoicing people and they're paying back. You're managing your inventory consistently, right? You have products that are stocking in and stocking out, and you're able to see when this product stock out and stock in. So all of these things are movement in the right direction that if captured, they are just as verifiable and useful data points as having a very long, extensive bank statement, which you might not necessarily have as a new business, right? And these things are important now. Like companies like Oze are important now because some of the other alternatives we have, like digital lenders and traditional banks and neobanks, consider lending to small businesses too high risk for the reward. And let me break that down into three things, right? One, the process of assessing the creditworthiness of these businesses is very limited. One, because they don't have as big a volume of financial historical data that some of these bigger, medium, and large enterprises have. And they just are not set up in a way that allows them to leverage alternative data in the way that Oze can, right? And because of this, many of them become risk averse. Risk averse means, okay, I don't want to risk lending to somebody that might not pay me back because I'm not entirely sure of their situation and I don't want to invest in being sure of their situation. So I'm going to avoid them completely. And another reason why they avoid them completely is because the amount of money it would take or the amount of effort it would take to scale up their lending process in a way that allows them to service small businesses is, for a lot of them, not worth it because it becomes a numbers game, right? They would have to be able to service a significantly large number of SMEs and have a large number of them be good borrowers to make even half the amount of profits that they would make from a smaller number of these really big vendors or these really big enterprises. And so that's why it's really important to take advantage of situations like this that allow you to leverage alternative data, especially at the early stage where your financial footprint is not as defined for you to be considered, marginally I guess marginally is what I'm looking for, marginally creditworthy. And so Oze has a few types of product offerings, right? Earlier, you heard me talk about secured loans and unsecured loans. And just as a refresher, secured loans are loans that require a complete guarantee for you to be able to access them. And Oze is able to offer two different types of loans: unsecured loans, where you don't need any collateral or any guarantee at all, and semi-secured loans. And semi-secured loans are offered through something called invoice factoring, where you are basically putting down a partial percent of an accounts receivable to be able to access funding. Okay, so here's just a little bit more information breakdown on what exactly you need with regards to some of these two different types of loan offerings that Oze has. The big thing that you could see here, and you can see this is why they are consistent here in the what you need, is recording your business transactions in the app. I'm resounding this so frequently because it's not that we just want you to record these transactions because we want you to record these transactions, because there's so much value in you having them recorded and you being able to use this data to access credit that would otherwise not have access to. And you significantly miss out on this experience when you don't. Your KYC is something like I mentioned earlier, is kind of standardized across as well, being able to link your bank account and share your bank statement, your 90-day bank statement or your Momo statements. The terms of each of these loans are different, but I guess we can talk more about them when we get to questions. I'm trying not to go over time. I think I have one more slide. All right, so just in summary to wrap things up before we go into Q&A session. On the left here, I have some of the misconceptions that I had pointed out to you earlier on, right? Only struggling businesses need loans. More financing is always better. And on the right, I have kind of the new ways we need to think about these particular things, right? These particular myths or these particular misconceptions, right? That's not only struggling businesses that need loans. Every business needs a loan at some point because there is value in deciding not to use your own balance sheet or your own money or your own runway at any given point in time to finance a project you want to do when you're in a very good and healthy position to borrow, right? More financing is not always better. More financing is sometimes worse. It is very possible to get an unsecured loan, and I think I have talked extensively about that. We have seen how interest rates are not the only cost that you need to consider when you are applying for a loan. And I'm hoping you guys understand the concept of like risk acceptance criteria now and how it's different with different organizations. And so because of these differences, it's very possible for you to be rejected by one person and then accepted by another person. And the application process for applying for loans is not always long and complicated. These days, it's hardly long and complicated. And companies like Oze, they use technology, make it really seamless and really easy for you to do. Bad debtors will not always end up in jail for not paying back loans. As a matter of fact, what happens is bad debtors find themselves in a situation where they deepen their financial burdens and remain stuck in the vicious cycle of dependence. So that brings me to the end of my presentation. Thank you guys for giving me your listening ears for this long. Do you have any questions? And just by the way, I have a member of the lending team on the call with me as well, in case you have any questions that is specifically targeted towards them.
Okay, we have a question from Richard. So Richard, kindly unmute yourself and ask.
All right. Good afternoon.
Good afternoon.
Yeah, my name is Richard. from Tropicana Trading Enterprise. I want to find out. I first want to appreciate this great lectures. I mean, it's wonderful. And my question is, if, for instance, I am a farmer, okay,
Mhm.
and I wanted to take a loan by using a property of mine to take a loan from my bank. But it's quite unfortunate. They said because the account has not been running for a while, there's no way they are going to grant me the loan. So in this case, I have a property that I want to use as a collateral. So
Yeah,
what do I do? How do I get it? Because I needed it to support the business.
okay. So
Yes.
thank you so much for your question. I have one question for you first before I go on to answer. Have you ever used Oze?
No, please.
Okay. I think this is one of the situations where there is an opportunity here for you to sign up and onboard and try out the app because, right, you wouldn't necessarily need to use the collateral. Oze doesn't require your collateral of that land to be able to process whether or not you would be eligible for a loan. What we would look at
Okay.
is your 90-day back statement. We would need to see that you have been recording transactions on the app. Kunle, I think you're on the call. Correct me if I'm wrong. I think it has to be up to, is it 20 days worth of transactions? Meaning if you start recording transactions today, right, of the sales and expenses that you make on your farm, and you project that 20 days forward and consistently record every day, right, we are able to like test your eligibility for a loan, right? We're able to, you can apply for a loan without necessarily needing to provide your collateral.
Okay. That is with Oze, right?
Yes.
Oh, okay. Okay. And my second question is this. Now, um, you know, in farming we have different seasons, right?
Yes.
Uh-huh. So in this case, other seasons you please just you got your more we more engineer. Sorry about that.
No problem.
What I'm trying what I'm trying to say is that now first season first season I didn't make much um, harvest because one or two reasons, and then the second one too same. And I realized that the amount of money that's supposed to go into it, I needed more labor into it.
Okay.
But because I was not having the funds, that was when I needed um, that. So in this case, since I don't have the much needed labor, the capital to get more labor, what other option do I have to get the labor without spending much,
So the question I'd
or
want to ask,
or thinking of going to going for a loan?
so the question I want to ask is, I want to just confirm I'm getting this right? That you're
Yes.
saying that if
Sure.
you had more labor right now, you would be able to produce more and sell more, right?
Yes. 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 Yes.
And the challenge that you're having and how, I'm trying to understand the question. And the challenge that you're having is that you just don't have the capital to hire labor and you don't want to borrow.
I don't have the capital to hire labor, like more laborers to work on the land or on the site.
I think one of the things to think about, one is, if you don't necessarily want to go into the route of applying for a loan first, you have to ask yourself, you have to now actually look within your business model, like the product and the way that you run your business, and understand outside of labor, what else is driving revenue for you? Like, what else do you feel that when you do more, you sell more of outside of just hiring people? Is there a particular, can you, leverage a particular season, and increase your sales during a particular season when you have like a high tide? Or have you noticed that, right, with specific other types of, I guess, costs of, like, I'm trying to think of like farming examples, right? So for instance, now, like, have you noticed that there's a type of fertilizer that is more useful and nutritious for your fruit, for your farm, because what you need to understand is that labor isn't necessarily the only revenue driver that you have, right? There are likely other things that you can consider if you really feel like you're not quite ready to look for a loan to hire more labor. I think, and I'm happy to do this with you after the call if you need to think this through to understand, well, what else am I doing is increasing sales outside of just hiring people? Because there have to be other things. It has to be, maybe it's a type of manure that I'm using on the product, on the soil, and on this particular batch of soil, I have more produce than some other time, right? Is there a particular farming technique that is kind of more efficient? Or are there more industrious things, so like equipment that would help you scale quicker, where it might be easier to even get financing for equipment as opposed to financing for labor, to achieve that?
Oh, please, is it a question to me?
Yeah, I mean, it's more food for thought, I guess, than the
Oh,
question.
okay.
Right? The point I'm making is, outside of labor within your business model, there is probably something
Yes.
else that is driving an increase in sales that is not just labor, right? And so
Okay.
if you're quite ready to go through the route of looking for capital to hire, you actually now need to look inwards into your business and understand what else is necessarily driving revenue for my business outside of labor. Is it the type of equipment? Is it the type of soil? Is it the type of, like, what else can I take advantage of in this moment without necessarily having to directly increase into hiring more people, right? You also want to think about, like, what does scale look like to you now? So how many staff do you currently have? How many laborers do you currently have?
At the moment, I have three.
You have how many?
Let me just say, I have three. Let me just say two, because one guy is gone.
So you have two. And
Yes. Yes.
can you ballpark, like, can you make a guess as to, the value of the work that those two people do, right? How much profits do you make? How much do you sell from all of the effort that those two people take into and bring to the farm?
Well, I would say the first harvest that I made from the two, from the three, I was able to make up to, because they were able to at least clear a little larger portion of the land for what I wanted to do. Okay, and that was the amount. After taking all the expenses that I made, I got a profit of 2,000 cedis. Yeah, so it means that in total
Sorry,
I
you said
spent
3,000 cedis?
no,
And how
2,000 cedis.
2,000
So I
cedis?
made I yes. So I made a sales of
And how many
6,000.
more people would you want to
And
hire? Oh, 6,000, sorry, the network is bad here. How many more people would you want to hire?
at least looking at the quantity of land available, and if I'm able to get 10 more people on the land, I think I'll be able to produce more.
How many more?
If I'm able to get 10 in addition, then I can be able to
Yeah.
produce more.
Internet.
Can you hear me, please?
I
Hello?
think, okay, so you want to be able, yes, I can hear you now. So you want to be able to hire 10 more. Yeah, I can hear you. Yes.
All right, thank you.
Can you hear me?
Yes, please, I do. I can hear you now.
Okay. Maybe we move on to the next question while we wait for him to come back. I'm trying not to use up all the talking about crop farm.
Hi, Richard. So, Richard, please reach out to me, and
I
then I'll
saw
put you
two
in touch
hands up.
I'll get
I
you in
saw Felix. Felix, you want to go ahead and
Please,
ask
I
your
should reach out
question?
to who?
Winnie. I think you're messaging me on
Okay.
WhatsApp. So please reach out to me, and then
Okay.
I'll link you with Emma. Okay.
All right,
Okay.
Felix,
All
are
right.
you
all right,
there?
all right, all right. Thank
Sorry,
you very much.
Emma. I think your internet is lagging a little, but Felix, please go ahead and ask your question.
All right, so good afternoon once again. My first question, I think when you were presenting on the requirements to access loan with your company, and then there was this part that has to do with linking our bank accounts with the app. So I wanted to know do you have any specific banks that your company recognizes, or we can just use any bank? I mean, the reason why I'm asking is some of us, because of our experiences with the commercial banks, we mostly have such bank accounts to be very dormant. Currently, for me, for instance, I operate with a credit union, and I know most lending institutions will not, let me say, they do not recognize such, financial institutions. So that's my first question.
Okay. So Kunle, could you please take this question? Emma has dropped from the call. I think she's experiencing some internet.
No, I'm back.
Okay.
I had lights change over, so my internet tripped off. I'm back. Can you hear me?
Yes, we can.
Okay, great.
Emma, did you hear his question?
Hello?
Hello, Emma. Did you hear his question? Okay.
Okay. Winnie, what was
I think it's the internet. Hello, Emma. Okay. Kunle, if you can kindly just step in for Emma, and then when she gets back, she'll take over. Hello, Kunle.
Yeah, I can hear you. How are you, Winnie?
that?
So, I'm trying to understand this question. Can you take it up again? It says he does not usually have transactions on his regular commercial bank statement, and
Yeah, let me just give the clear picture, right?
thank you.
Now, what we face as business people is that our commercial banks, I have account with Access Bank per se, and I have not been able to access credit from them ever since. So what happens is that when we get the source of funding from, let's say, a microfinance, we have to be servicing the loan that we got from the microfinance. So it then appears that our commercial bank that we have an account with always appearing dormant, because at the end of the day, you want to service your loan first before, probably, if you have any profit left, you can go to your commercial bank. You get it. And then by so doing, such bank accounts become very dormant. So what I want to know is that if we are to link any account to the Oze app, are we looking at whether it's a credit union, it's a microfinance, so far as it's a financial institution that we have an account with, can it be linked to the app?
So I'd like to ask, what's the name of the MFI? And are you in
Currently,
Nigeria or Ghana?
I am in Ghana.
Oh, okay. Basically, we usually use if you have a Momo statement, it will be linked. But from what you are saying, you do not transact with your Momo statement. Am I correct?
We do, I do transact with my Momo as well.
Okay. What's the highest loan
We
you've
pay into
taken?
the Momo.
Okay. What's the highest you've taken? What's the highest loan amount you've taken before?
Highest, that should be 10,000 Ghana
Okay.
cedis,
What's your monthly
10,000.
turnover? What's your monthly turnover on your Momo statement?
Monthly, my Momo statement should have about 6,000-7,000.
Monthly,
That's
month on
on a good, yes, on a good month.
good. On a bad
You know,
month, what?
on a bad month, at times it will be around 1,000. Because the kind of business I run, I'm into hostel facility. So I have acquired an apartment that I intend rent to students on a semester basis. So in a semester, we have 4 months, right? So in a month where students are reporting to school, in terms of money flowing into my Momo statement or account, it goes up very high. But then when students are on vacation, all of them vacate the premises. So such months when there is vacation, you don't see much of financial transactions on my statements. Yes, so that is the structure of my business.
Okay, you can actually reach out to Winnie. We can, if you want a loan from us, the requirements are very simple. Download the Oze Business App, enter your transactions, no matter how seasonal your business is. We'll factor a lot of things. In the repayment schedule, we can build a repayment structure for you, whereby when we see that money does not come at a particular period, we won't tie so much repayment at that period. So it can be structured, you know. Oze is about flexibility for businessmen, business owners, case by case, you understand? So can reach out to Winnie. I can look at your bank statement, and we can actually see what you can get from us.
Okay.
So I just want to add, thank you so much, Connie, for covering that. You with Oze specifically, right? Because we use machine learning to do our credit scoring, it can take into consideration that your business is cyclical. It's not looking at your business and saying, oh, okay, between the months of July and September when nobody's off, right? He's not making any money, because they're seeing that pattern where, right, every year over a period of time, right, there's this specific there's a specific gap and there's a reason for that gap, right? So these things are taken into consideration when all of the information is put into the model.
Okay. So can I go ahead to my next question?
Yes, please, Felix.
Yes, so I also want to know whether there is a possibility for us to finance an initial starting business. The reason I'm asking is I have also started a remedial school here in Ghana, and I used to do it on a small scale, but then just last year, I managed to acquire a bigger facility that can actually take over 100 to 200 students, per academic year. But then as it stands now, after acquiring the facility in terms of rent and then also furnishing, I realized that capital to keep running in terms of advertisement and also some kind of cashback that can help with teachers' payment until turn up students number increases. So I don't know, because per your submission, I realize that you are looking at businesses with a certain kind of financial record history. But in such a case where I am now scaling up and I have specifically not had any transactions to that effect yet, is there a way that Oze can come into support?
So the one question I have for you is that, do you use, for your two different businesses, do you use the same bank account, or do you use separate bank accounts?
Separate.
Okay.
So for the remedial school, as I said, initially I was just doing it as let me put it as part-time, where I normally teach students who are on vacation classes and all that. Then fast forward last year, November, I decided to go in for a place where I can have students coming in. That is the secondary school in Ghana here. We call it the SHS. So we have about 3 classrooms with 4 rooms that will be used as hostel for the boarders.
Yeah.
Yes, and so all those things done, and then we have acquired over 40 student dexes as at now.
Yeah.
And we also started a few advertisements, but then realized that as it stands now, there's no cash to continue with our advertisements. And then in this kind of business, advertisement is very, very paramount. Yeah, so at the time that I was doing it on a low scale, it was not something I was really focusing on. But now I want to integrate it as a complete business and have separate account for it, and then see how far I can get. But then I don't know if
So
there's a way that Oze can come in.
I actually want to challenge something that you're saying here, right? And it's taking me back to like an earlier point in my slide where I was asking, and I think it's important to ask, right?
Yeah.
How sure are you that injecting money is the solution to the business, right? Because what I'm hearing now is that with this new business venture that you're trying out, you have done some little advertising and you haven't necessarily seen the positive return on that yet. So what I'm trying to understand is why you would now think that scaling up to do more advertising would immediately turn to more sales, like you being able to get more students.
So for the academic calendar here, mostly such students start coming in from April, May of the year. And just last month, I ran a Facebook advertisement, and the advertisement just ended about 2 days ago. So out of the advertisement, I was able to generate about 55 to be specific leads, which are contacts of prospective students. And then out of this list, we have 10% of them coming in person to the school to pick registration forms. And then some of them have been paid for the form. So what we do is that before they report to school, they will have to pay 50% of their fees before they come in. Yeah, so I believe that the little advertisement we did, I mean, it just ran for 5 days on Facebook. It just ran for 5 days. And I think I paid in terms of dollar, I did it $1 per day. So I paid $5. Yeah, so we did it in categories. So I was spending about $20 going. Yeah, so that was the outcome. Yes, that was the outcome. So I was just thinking with my team that if we could probably move a bit further to the more traditional in terms of television or radio advertisements, in addition to the online, then we could probably have a good number of students turning up. So that
I think one of the things to consider, and I have one more question before I give you that, is would you be able to, you said you started this in October and November, which means you don't necessarily have up to 90 days of a statement, right? You might have just thereabouts.
Yes, I think I will have statement for
From when?
probably that should be November.
I think what I would recommend is, I think you should make the effort to sign up to Oze, right? You have a 90-day statement, you have a Momo statement that fits into that time frame. Another thing that would really help your case is actually putting in the transactions, right? I'm hearing that you've had a lot of expenses that you've been making, right? You actually should be documenting, as soon as we get off the call and you're able to sign up and get into the app, actually start documenting some of these, expenses that you're making and the sales that you've made so far. You mentioned that from the ads you run, that you've already sort of been able to convert some of these into sales. I think where you might land is because you're still fairly new business, I don't think you should be aiming to immediately scale up so large, right? I think you should be looking to scale incrementally. It's hard to say what the data would say in terms of would you be eligible or would you not, but I think the way you should be looking at growth here for yourself is not necessarily scaling from 0 to 100, but making the small incremental changes, because it already sounds like you're on the path to do that, and even just adding a little to that could significantly increase the return that you would get.
Okay. So finally, I think for the Oze app, I have started with a hostel business on it, but then I don't know if I will have to use the same interface for the school business that I am talking about now. I have to download as a separate app and then enroll the school business on it. So how would I go about that one?
Hi, Felix. So if you have another phone number, you can use that to set up the second business.
Okay, but then it can be on the same phone.
Yes, yes, on the same phone. But you just log into different accounts. So you just create another account with a different phone number. So you have your two businesses. And you can use the same login. Yes, please.
Okay, thank you very much.
Thank
you so much for your questions, Felix.
Emma, I wanted to give an exercise. I don't know if...
Oh, I did want to give an exercise. So one of the things that is really clear, and I hope this was one of your takeaways from listening to this entire workshop, is, right, a really big part of borrowing for growth is a function of planning, right? How much time are you taking into studying the progress that your business is making? How much are you taking advantage of, the outstanding cash balances that you're able to record in your Oze app, or even the analytics that you have in Oze app? Right before our call, I put together a little kind of sales budget plan template that I had intentionally planned to share with everybody, but I felt, you know what? There's no free lunch. And I think it would be a great engagement exercise to really kind of get you guys excited about using the app and interacting with the app, where for the first 10 of you who are able to consistently record 5 transactions every day between now and the 20th, I am happy to hold individual sessions for us to go over your sort of forecasted sales plan from now until the end of December using this template that I've worked out. And in as much as this sounds like work, part of the reason why I really want you to take the effort to do this is in between now and December, like even between now and March, right? Whenever we schedule to sit down and speak and go over your plans and whatever help or coaching you might need, one of the things we might find is that you could be eligible for an Oze loan, and I think it would be such a disservice to not have taken advantage of actually going to record your transactions every single day. And being at that point where, okay, now like you have all of the things that you need to be 100% eligible, but then you didn't record any transactions, and so you would miss out on this. And so I'm really challenging you guys to take this seriously, because I think there is a lot of value at the end of the day in sitting down to make this plan together. And I'm excited to do this with as many of you that I can.
I think we can send everyone that's registered an email with their details for this, so that you guys
Yeah.
can take part in it. But yeah, if you guys could kindly come show Emma some love with some emojis. Emma, thank you so much. This workshop has been amazing, very informative. I've learned a lot personally. I'm somebody who doesn't like to borrow. I don't like owing people at all. But I mean, I think as time has gone on, I've understood that even rich people who have a lot of money, people that are very rich, they tend to borrow and then pump the money in their business. They don't use their own money. And when they do that, they're able to even grow their business larger. So I hope this workshop took away all the fears you had in borrowing, and Emma left us with some golden nuggets. I think what I'm going to take from this workshop is that you have to learn to borrow from a position of strength. So when your business is in a good position financially and is capable of managing debts, it's a good reason why you can borrow. When you're consistent with your financial recording, and also you have a strong history of transactions, it's a good time to borrow. You also have to know the difference between increasing productivity and also increasing your costs. So you don't want to borrow when you have high cost, so you're spending, because if you're borrowing with the idea of paying more money back, it's not the right reason to borrow. And finally, not being afraid to reach out or being transparent to your loan officers to discuss loan terms and when you're experiencing any cash flow changes. So I think most importantly, if you're a small business and you want a loan, you need to make sure you have good financial record data. So thank you so much, Emma. We appreciate your time. Thank you for everyone that joined.